Hello and welcome to the Mutual Fund Show. I'm your host Neeraj Shah, and today we'll be discussing two topics. One, if you are an investor in a Flexi-Cap fund, particularly a Flexi-Cap fund, and if the AUMs of those funds, by virtue of the stupendous performance in the last few years, have become larger, would you or should you switch to some of the newer schemes which are also managed by reputed fund managers or AMCs, because it might be difficult for a fund with a larger AUM to outperform relative to some of the smaller AUM funds. So that's the first one on our radar. Of course, a bit later on in the show, we'll also try and ask a question which invariably comes up every 3 months or 6 months, but even more so now, that if indeed fixed returns in bank deposits might be at a particular level, let's say 8% or 9%, is it prudent to use them as opposed to try and invest in a debt fund at the current juncture? To talk about both of these topics, I'm joined by two experts, Salonee Sanghvi, founder at My Wealth Guide, and Santosh Joseph, founder at Germinate Investor Services. Both of you, thanks so much for taking the time out. Really, it's a pleasure to talk to both of you. It's been a while that I've spoken to you, so great doing this show together. I'll start off with the first topic, which is, Flexi-Cap funds in particular. This could be applicable to any scheme, but I'm using Flexi-Cap funds as an example, wherein the size of the fund has become very large. There is a Parag Parikh, which is at an exceptional performer for the last 7, 8, 10 years maybe, and the fund size has now become very, very large, the equity AUM. Similarly for an HDFC or some of the others. Salonee, can I start off with you on this? That's typical, right? As a fund size becomes higher, would it find it difficult to outperform, and therefore should people look at smaller funds?
Thank you so much for having me, Neeraj. So before we look at specific funds, let's look at some of the parameters that you would look at to, pick a fund to invest in regardless of the category. First is returns. Now, while obviously past returns are no indicator of future returns, it helps us understand how a fund has performed across various market cycles. Second is risk. As important as return is, risk is even more important. A fund could have performed well, but the manager may have taken excessive risk to achieve that. The third is obviously the fund manager style, whether it's growth, value, quality, etc. And also consistency in case of if there are fund manager exits. And the last is AUM. Now, a small AUM could be an issue if there are large redemptions in the fund. A large AUM would be more of an issue in small cap funds because it restricts the opportunities available. Given that most flexi cap funds are often large cap biased with around 70 to 80% in large cap stocks, I think the large AUM is not a drawback. And high AUM is obviously, of course, built on the back of good performance. So if we were to just quickly look at the performance of some of the funds with the highest versus the lowest AUM in the category, if you look at Parag Parikh, which you mentioned, that has outperformed the benchmark across most time frames. Whereas if you look at the funds which are in the lower AUM category, they've actually underperformed the benchmark across most time frames. Now, when we come to the specific fund houses that you mentioned, a track record helps to understand the kind of risk that a fund is taking, how well it does in a bull market, bear market, and because there's a lot of data available, you can analyze it and determine if it is the right fit for your portfolio. In a new fund or AMC, you only know the broad strategy and mandate, but you don't know whether that strategy is actually going to work. Of course, a good fund manager does add confidence, but I feel like if there are enough, existing funds in the category with a track record, I would prefer to look at those. In fact, even if there are unique strategies, it's better to wait for some time to see if that theme or investment strategy actually plays out before investing in those funds.
Okay. Fair point. Santosh, coming on this one, what are your thoughts? And the added layer that I'm adding to this conversation is that there are, in the last 12 months, there's a slew of new funds that have come in, which are managed by fund managers or houses, which have had a track record in different ways, right? In Old Bridge, Kenneth Andrade has run an AIF very successfully and has a track record of IDFC in the past as well. Similarly, Helios and Samir Arora's track record out there, or Trust, which has got Utpal Sheth and Mihir Vora's track record. So in some sense, newer funds, but managed by people with immense pedigree. And we know what Quant has done. I'm not saying that therefore others will do that, but a new fund house comes in, disrupts, and does great returns as well. So my larger question is, I take on board Salonee's point that flexi-cap funds are large cap buys and therefore liquidity is not an issue. But the overall size, could that hamper outperformance moving ahead relative to what could happen to some of these newer funds?
So great question, Neeraj, and there are two parts to this. Let me just break it up. One, all the new guys that have come in the last 12 months, I like all of them, and I think you so rightly said, all of them come with great experience, the number of years that's spent in the market, and also the pedigree. Now, whether it's Helios or whether it's Oldbridge or whether it's Trust, we have no problem with the offering or even with the portfolio manager because they've got a clear, proven track record. Now, coming back to flexi-cap funds and the size. Are we worried about the size of a flexi-cap fund? The answer is no, and I would like to put some perspective to it. The markets themselves broadly have actually grown quite a bit. If you look at the mutual fund industry AUM at over 50 lakh crore has grown, and therefore you are bound to have some funds which have got track record and performance to be large funds like these. It cannot be that the AUMs are growing and funds will not become big. Now you also add another layer of perspective that even the market capitalization of many of our stocks have gone up significantly. Now you take the largest flexi cap fund, let's say 60-70,000 crores, and you take the largest holding in that, let's say another 6,000 to 10,000 crores. Now that 6,000 to 10,000 crores in a large cap stock, which has got, let's say 5 lakh, 10 lakh, 15 lakh crore market cap, really not a cause of worry. Now, the good thing is that these funds are also becoming large on two reasons. One, they're performing well, therefore the size is growing. Also, they're getting a lot of inflows because of good performance and good track record. So as long as you have those things working for you, whereas where the market is growing, the market capitalizations are growing, the fund is delivering, and the portfolio manager is able to meaningfully add value to incremental monies and manage the existing investors' money well, I think there's nothing to worry, and flexi caps are here to stay and will do even better.
Okay. Okay, fair point. So both of you are on the same side of the argument. Salonee, I'll just ask one question, and this comes in because there are a few people who are saying that, if I have a limited amount to put in a flexi cap fund, and I have existing SIPs into those large funds, but there are these new fund houses with very attractive fund managers with a very attractive track record in the past, should they be looked at? And in some sense, the small size might just help going ahead. I mean, if the AUM for, let's say, an HDFC would double from here over the next 5 years versus some of the newer funds, then the outperformance possibilities might also change. Is that a valid argument or not quite?
I don't think that's valid. I think, the point that we've made, there is a lot of room in the flexi cap funds, even the current funds, given the current AUM to grow, there's a lot of room there. So even if one were to continue the SIPs, I think there's a lot of room. So it, just size is not the only determinant of whether a fund would do well or not. I would give some of these new fund houses maybe a couple of years to see how their strategy pans out before investing significant amounts in them.
Fair point. So just for the benefit of our viewers and before we take that break, Santosh, so if I were to ask you from the funds which have traditionally done well, and I think there was some graphics which showed how PPFAS or some of the others have had a very nice track record for a number of years now, but it's not the only one. I mean, whatever else out there, from amongst the flexi cap category, which are the ones that you like the most? It not be an exhaustive list. It's effectively a representation or two from the many that you might be liking, and why?
So yes, Parag Parikh on the terms of size or HDFC Flexi-Cap, all these have done well, and any Flexi-Cap I think that's got over a 5 to 10 year track record is good, both for keeping the funds and for continuing to hold in them. Now, when one looks at the whole flexi-cap as a space, and we need to understand that this was birthed out of the need that when SEBI scheme recategorization happened, you had this one large multi-cap category where you had to really put them into a particular basket, and that's when flexi-cap as a category came, gave the fund manager the ability to navigate between large caps and a certain bit of mid and small cap. So therefore, Flexi-cap as a category is now become our good old OG, which is the diversified equity fund category. So without being biased with any name, anybody with a 5 to 10 year track record is a straightaway go-to.
Okay, Salonee, would you be able to tell us what do you like as an example or an illustration within the Flexi-cap category?
I think currently, of course, PPFAS is one fund that has, over a period of time demonstrated. I think 361 focused equity is also a good fund to look at in that category.
Okay, well, those are some examples, and thanks both of you for breaking this notion in some sense. I was trying to play the devil's advocate, but clearly both of you believe that there is not a problem there. So viewers, if you're listening into this conversation, whenever, whether on TV right now or on digital later on, let not the size of the Flexi-cap fund at least bother you. I think Salonee made an interesting point that for a small cap fund, this argument could still be valid because of liquidity, so on and so forth. For a Flexi-cap fund, I think there's still some room to maneuver. So some of the well-performing funds might still be the go-to funds to look at. We need to take a break, of course. We'll come back from the break, talk about the other topic, which is debt funds versus FDs, if you will, at the current rates. And time permitting, we'll try and take some queries as well.
We as professionals understand the importance of making informed decisions and often are advisors to our clients. Voting is no different. As citizens of this great nation, we have the power to shape its future. And one of the most crucial ways we can do that is by casting our vote. It's not just a right for every citizen, it's a responsibility. A responsibility to ourselves, to our communities, and to our country. So, I urge all of you to exercise your right to vote. I always ensure that I fulfill this duty to our country. Let's show the world the power of our democracy, the power of our collective voices. Together, we can make the difference. Together, we can build a better tomorrow.
Back with the Mutual Fund Show right here on NDTV Profit. A couple of very interesting queries. And Venkatesh, let's start off with the queries actually first, and then we'll move on to the second topic. Venkatesh has a query. Venkatesh Miriyala is aged 39 years. His goal is to buy a house. He's saying that I've been investing 50,000 rupees a month since the last 1 year in mutual funds. My goal is to buy a home after 20 years, and the house currently costs 1.2 crores. Will I be able to achieve my goal without a bank loan through these investments, or do I need to change my strategy? The current SIPs are in Quant Small Cap, ICICI Prudential Blue Chip, 10,000 apiece, HDFC Flexi-Cap, HDFC Top 100, and Quant Mid Cap. Well, that is his bifurcation. The timeline is long. Santosh, can I ask you to advise Venkatesh?
I think this is a good thought, a brilliant approach to begin with. Now, the straightforward answer is you don't need a home loan. I think you're well sorted with this. Now, there are just one or two assumptions that I have to make for you, Venkatesh, to give you this answer. Is that number one, you also have to consider that the cost of home, which is 1.2 crore today, 20 years from now, will not remain the same. Of course, you have to take into account inflation. And therefore, with that assumption, I would think that the cost of the house will be between 3.5 to 4 crores in a 20-year time frame. Now, let's look at your SIPs. What are they going to achieve over the next 20 years? Now, I'm not going to disturb your choice of funds. And I think the most important aspect is the fact that you've chosen a good bunch of diversified equity funds, and you have a 20-year track record. Now, just the corpus that you will accumulate will be about 1.2 crores. Now, if that were to grow at 10 or 12 or 15, the numbers will be between 3.8 crores or 5 crores or 7.5. Now, in this perspective, in a 20-year period, your corpus would be, even at a 12%, over 5 crores. Now, using that money, you will very comfortably be able to buy your home without a loan. And as an added bonus, you'll have some money left over, which could be a portion of your wealth or something else that you can fund yourself for. But this is a nice way, and I'm glad you asked this question. It is possible. You will actually do better for yourself than taking a loan right now and struggling through the 20 years. But at the end of 20 years, you'll have a brand new home at extra savings also left for you.
Okay, so that's one advice. And Venkatesh, I hope this answers your query. I'll ask Salonee to give a response on the second query because time is short. And the second query is from Rahul Das. Goal is a retirement fund. And Rahul, Salonee says that I'm quoting him, I'm planning to invest around 75,000 rupees a month for the next 10 years. I'm ready to take moderate to high risk. Please suggest 4 or 5 funds to diversify my investments. Do you reckon you can advise Rahul, Salonee?
Sure. So, Rahul, prima facie, it's difficult to recommend the right asset allocation without knowing, your risk-taking ability and age. But I assume that, you're relatively close to investment because you mentioned a 10-year horizon. So I think the way you could split the 75,000 is look at 30% in maybe 2 good Flexi-Cap funds. You could look at PPFAS or 361 focused or any other good Flexi-Cap fund in the category. You could invest another 30% in a mid-cap fund like Kotak or emerging equities, and maybe a 10% in a small cap fund of your choice, maybe a Nippon or SBI or Axis. So I think that is how I would look at investing for the next 10 years.
Okay, sound advice, I'm sure. And Rahul, I hope this helps you. I'm sure it will. Thanks for that, Salonee. Okay, now the other topic, which might be a slightly broader topic and not necessarily a query. And Santosh, I'll start this conversation with you. There are people in my office who are asking that FDs are giving a particular rate of return currently. Debt funds are giving a particular rate of return. Why should anybody invest in fixed income instruments via the mutual fund route currently when fixed deposits are giving the kind of returns that they are? If they're willing to hold on to the fixed deposits for over 5 years as well, then there is some tax benefit that comes in too. So could you tell what would you do, Santosh?
Well, the debate is across the board, not only in your office, but all over the place. The investor community have this notion in their mind that when you have the FDs at an attractive rate, and I'm sure all of us have been getting those teaser SMSs from some of the banks that how if you take it for 13 months or 25 months, they give you some good rates. Now, straightforward, the answer is that they are on par right now. When you are able to get a good issuer at a good rate, I think then the clear answer is if that is the point of convenience for you, you should go for it. I've for long maintained that anything more than 7.5% gross yield for an investor is great, because we know that right now that long-term capital gain benefit being stripped away from the debt funds, right now you're on par, and therefore your choice will be largely dependent on the yield and also the convenience at which you can make this investment. Now, we also have to keep in mind for a lot of investors who are still not, even to this date, comfortable with mutual funds or especially fixed income mutual funds because of the little bit of varying degree of difference in returns that they see. For them, FD becomes like a de facto choice. So therefore, I would say choose your convenience. At 7.5%, 8% or 8.5%, or even 9%, if you can get a good FD from a bank that you're comfortable with, go for it. Mutual funds do have their place, maybe for hybrid funds, maybe for savings funds, and maybe even for the longer term aggressive equity investors. But clearly, the answer is choose convenience and choose the yield that works for you. And I think 8 or 9% yield is lucrative to make that decision.
Okay. Thanks for that, Santosh. Salonee, how do you think about it? And your answer could be completely different, which is fine, but would love to hear.
So I think FDs are definitely a great option, especially if you know the exact duration and don't need to break the FD. Also for senior citizens who get a 0.5% higher interest in most banks. But I think one thing that people should be aware about FDs is that if you break the FD, you could be charged a penalty. And secondly, you also get a lower interest rate for the premature withdrawal. So for example, you have a 2-year FD, but you break it in 6 months, you will get the 6-month interest rate and not the 2-year interest rate. And most of the higher interest rates are usually at the longer term or, 2 years, 3 years, 5 years kind of a horizon. Liquid funds have given a similar return and can be a good option for shorter term needs. So if, you need funds for within 1 year period, or you're not sure exactly when you may need the funds. So this could be a good option because there is only a 7-day lock-in, so it can be redeemed anytime. And the return that you would get would be similar, whether you do it for 1 year or for a shorter period, the return that you look at would be similar in that sense. Of course, there is no guarantee of fixed return as there is in FDs. And the benefit is also you pay tax only on redemption, unlike in FDs where you have to pay tax every year on the accrued interest. So even if you have a 5-year FD, you're still paying tax every year. I think another good option that people could look at is arbitrage funds, especially because of the tax arbitrage. They've given a return of around 7.6% on average in the last 1 year. So say if we were to assume a 7% return on an arbitrage fund after 1 year, that means a 6.3% post-tax. Whereas if you were to look at any other debt mutual funds or FDs, that would be a return of 4.9% post-tax. So I think that is also one option that people could look at.
Okay. Well, and the tax arbitrage still exists, at least until this budget. Let's see if there are changes thereof. So that's to be kept in mind, but pertinent point. Great. Take a moment to thank both of you, Salonee as well as Santosh, for joining us and giving us your perspectives. Must admit, both sets of the answers are completely different than what I had thought it would be, and therefore it's great to have such a conversation on the show. Thanks for your time and your advice.
Thanks, Neeraj.
Thank you so much, Neeraj.
All right, that's our guests with their views. I hope this show was helpful to both our viewers who asked for the specific query, but on two very pertinent topics, at least to my mind. Thank you for tuning into this leg of the Mutual Fund Show, but stay tuned to NDTV Profit for more news and updates.
Hello everyone. I urge each one of you to exercise your right to vote. Your voice matters and all our votes shape our collective future. Let us make democracy stronger by going out and exercising our franchise. Jai Hind.